Stocks continue to slide today, following up on yesterday's selling. And this little bout of selling is a little different compared to the last batch of selling that we had a couple of weeks ago. So I'm going to break down what those differences are and what their implications are and what we can expect because of it, and talk about what our expectations are. There's some pretty significant technical patterns showing up here in the last couple of days that tell us what we might be seeing here in the next few weeks. So I'm going to break down what those signs are, what our expectations are. As always, that's what you always get from me, what I'm expecting to see, not just in the short term, but also in the more intermediate to longer term, as well as a trade idea for a stock that is showing its own similar breakout patterns. So let's go ahead and get started. Today is Wednesday, May the 13th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and get started on this Market Outlook video for today. As you take a look at the S&P, it's second down day in a row, second straight 1.5% down day, ended up 1.75%. In this case, you can see we stayed above the moving average, so it's still green. All right, if we were to close below it, it would have been yellow, and obviously when it rolls over, it turns red. If we're below it and it rolls over, it turns red. So we're not there yet. We still have dark green shading. So, I mean, despite this seemingly pretty darn bearish decline, we're still strongly bullish. And long-term market sentiment still rising. So, you know, a little bit of perspective there. Now, in the case of the Russell 2000, we're not as bullish. And it's had more of a bearish market forecast because it's been more of a bearish chart. And you notice we are dropping back outside of this retracement zone. Now, once you break through 1140, then things start trending to the downside again. So just keep that in mind. We're still in the retracement zone. That's the bigger dotted area line. This is just resistance. And, you know, again, it's when you are outside of this resistance area, there's a good chance of breaking back below that. So it's definitely something to keep an eye on for the Russell to see, okay, who's going to win this tug of war? You have the Qs, which have broken out of the retracement zone to the upside, only to come back in, but still in between. The 662 is all the way down to the 30-day moving average. So it kind of puts in perspective here that, you know, we're not really that bearish right now. It's just a little bit of a pullback. The S&P 500, we're just now hitting the middle. We can go all the way here to this 2650 area and still be just trading in space and not really making a trending move one way or the other. And of course, you know, worst case scenario, and I've been mentioning this for the last week or two, and the worst case scenario in any kind of short-term pullback here, intermediate decline, is coming all the way down to this level. And that's, you know, again, more of your more likely scenarios. We just stall somewhere in this retracement zone before we rise up. But again, you know, the Qs have broken all the way up through what would be the equivalent of 3150 or 3133 here on the S&P. The Qs have already broken up that high. So the Russell is back down below this. So, you know, again, you can see what's pulling the markets from either direction. The outperformance of these large cap tech names, the underperformance of other sectors that are more dominant in the Russell, like the industrial sector and a lot of small cap energy names with their high yield, linked to high yield bonds, as well as financials, all in the Russell. So, you know, you see the tug of war that's going on here, and that's been shown in the types of trades. You'll see that later today in today's trade idea. So that's what we're seeing on the S&P 500. You know, again, look at the short-term decline here. This is the worst short-term sentiment, at least measured by the near-term line, the blue line, than we've had during this whole rally, all the way since this cluster. And really, even that cluster wasn't as bad on the near-term line, but really since this cluster. But, you know, again, this has been the worst near-term sentiment. And, you know, again, that can be posture changing, not trend changing. I don't think we're going to trend lower. But, you know, are we likely for this kind of posture change where we at least turn weekly bearish? The intermediate line turns down, and I don't know if it goes all the way below 50. I'll show you here in a minute so we can know if there's a good chance that it will. Like, say, versus in October of last year versus January or early February this year. We'll show that difference. You know, so are we going to be that bearish enough to pull back. See, neither one of those were preceded by nearly as bearish of a drop in the short term as we had right now. So it kind of, again, shows you just how bearish we are in the short term, especially coming after multiple extreme lows on the momentum line that we didn't, we've gotten a lot of oversold momentum lows here. And not very many strong overbought momentum highs. It's one thing to get the momentum lows, okay, but as long as we're followed by momentum highs, that's another story. But we're not getting the red line getting up here. It doesn't have to, but it's more, if you're going to get those kind of lows on the downside, then I would like to see those kind of highs on the upside. Generally, when you're bullish, and you can't really see as much here, but generally you don't get the overbought on the upside, and you don't get you don't get the extreme lows on the downside, except for a couple, here that was followed by an extreme upward move. So we really need to see an upward move in the momentum line that follows all these extreme lows, and we haven't yet. So that's a little bit of a sign of concern from the market forecast for the S&P, and of course the Russell is even worse. Right, it's been more extreme to the downside. It's had one little pop to the upside, but even this pop that big catch-up pop here in 3 days that preceded this first rally or first drop that we're comparing this one to. I mean, that one didn't even have momentum lines getting up, and the near-term line barely got up there too. The near-term line also to its lowest level since this would be the March 12th cluster. The March 23rd cluster, it didn't get one on the Russell like we did on the S&P, because they got the long lower shadow here that the S&P did not get. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon. It's right here down below the video. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one of these videos tomorrow. If that's the way you let us know. We check all the views. We check how many thumbs up we give. We want to see whether you like these videos and you want us to keep doing them. If that's the case, let us know right now while you're watching. If that's not the case, then you don't have to click on anything. Also, while you're down there, comment. What did you get out of the video today? I always love to see any questions or comments you have about anything I talked about, or for anything I didn't talk about that pertains to the subject of our videos. Again, join our Market Scholars website. There's a link popping out right there in the top right corner of your screen. You can click on that link, subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things that we have on our site, including our Market Outlook live trade review videos. Here's where we go through all those trade ideas that we talk about. We manage all those trades all the way to the time that we close them. We do that every day. I do the Market Outlook. We also put on the trade idea for today's video already. We've already put it on in our portfolio at 3:30 Eastern time, so about a half an hour before the market closes. So if that interests you, check that out, as well as all of our trading rooms and calendar of classes we have. The Q&A sessions you can see posted here, that's a premium a coaching session, online coaching session for our premium subscribers. Our monthly subscribers will get access to all of our trading rooms. We have 8 of those every week. Here's more information right here above the video for that plan. Also, engage with us here on social media. Click this heart that opens up this window. Hit that like button. Same thing with the thumbs up. Again, we benefit when you like our tweets and our Market Outlook posts. Because those platforms will promote our content to all of our followers. You benefit from doing that because they will promote content in your timeline from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's get back to the charts, and let's take a look at the long-term chart for the S&P. And we talked about like getting a lower shadow today. Well, there we go. We got a lower shadow here. So we didn't get a higher high on the well, we kind of slightly high, but we didn't get above these highs here on the on this week's shadow. The body doesn't appear to be as now. Again, we're 2 days away from the end of the week, so keep that in mind. But as of right now, the body wouldn't be that bullish because it's right about the same equal levels again. And then you can see we did get a lower shadow. So after touching the 200-day moving average and getting back below the 50-day moving average, which is a little bit significant too. That kind of shows, it's a little bit of weakness here. And of course, when you look at it on the Russell 2000, it looks even weaker than that, right? We're well below, we're not even close to the 200, never did touch it. We're well below the 50-day moving average again. And its Hakinyashi candle is really a transition candle. Very small body, big shadows on both directions. That is about as transition of candles as you can get, especially at a resistance level. So, keep that in mind about some short, where we can be going here in the near term in the next week or two. There's some signs of weakness showing up on these charts. Let's take a look at the 3 green arrow chart. For the S&P, you can see we're two red arrows, and the reason why we got the whoops, not that one yet. The reason why we got the red arrow on the stochastics is we came back and we rolled over, and this phantom red arrow, which slight divergence there, not nearly as low of a high point as this is stochastics, but we're back below its moving average. And then you notice the MACD never did get the green arrow because the MACD never did cross above its moving average. And we're back below the 8-day moving average. Now we haven't crossed the 30, not just below the 8. That was yesterday. We're below the 17-day moving average today. So, again, breaking below the 17-day moving average is a little bit of a kind of a warning shot of a change in direction here. So kind of keep your eyes out on that, because if you look at the same thing for the IWM, we're well below, and you can see the MACD and stochastics turning. On the other hand, on the flip side of this, the Qs haven't broken their 17-day, and it's even with its stochastics is still in the upper reversal zone. So you can see the discrepancy again, the tug of war between these tech names that even during the last 2 days, if you just look at a comparison chart. So this is a comparison of the Qs to the ETF, to the IWM over the last 2 days, including the overnight move yesterday. And here's the regular trading session, then the overnight, and then the regular trading session. So 2 down days here, and you can see that the Qs have lost half of what the Russell 2000 has lost, IWM. So even during the decline, like previously, if you go back to when this rally really kind of took off on that gap higher on April the 6th, and let's go to a 30-minute chart. And here, let's take off the full fit the studies, and we will not show the extended hours for now. All right, so you can see, here that the IWM actually rallied higher than QQQ, but since then, IWM rallied high, but since then you can see IWM is really pulled back relative to what QQQ is doing, especially over the last couple of days. We had a nice little run. That was kind of our catch-up run in IWM because Qs were outperforming. And then we pulled back, okay, and then, they had a pretty decent rally, but, for the Qs to continue to really outpace by a wide distance, outpace what IWM is not, again, it kind of shows where the market leadership is, remains to the upside. And until we start to see those leaders underperform, that's when it's like, okay, now we might be in a bearish trend. Like we might be down for a while. Otherwise, if we get some weakness, and it might last more than a day or two, but the Qs continue to show this kind of outperformance during the weakness, then we know, okay, this isn't over, right? We are still okay, and the markets are still following suit, and with its leadership still leading. And in other words, we have that breakout that the Qs have had here recently. There's a good chance that can persist and bring these other indexes up with it, as long as they maintain their leadership through this volatility. All right, now let's take a look at the intraday chart. And something that stands out here, first of all, we broke into the lower half of the range. We haven't done that. See, this wasn't the lower half of the range back then because the lows were a lot lower. So this is the first foray, and you can see it here on this chart for those of our subscribers, premium subscribers. You get these charts. 6i is what we're looking at here. And you can see this is the first time since we broke out there on April the 6th that we've fallen into the lower half of the range. Now, we've done this before without the orange line getting into the lower half itself. Here's another example, and so that would keep us from changing the trend, right? It's when the orange line falls below, that's when we can be a little bit more bearish. But you can see getting into the lower half, we might be down there a day or two, we might be down there a week, we might be down there for who knows, right? A few weeks. This was about 4 weeks here before we broke out to the upside. So we'll keep our eyes on this, especially if it makes its way not just below into the lower half of the chart, but also into the lower reversal zone on that really first move. Even this one didn't get it on the first move, kind of did on the second move before moving back up. So if it gets down there in the first move, then we have a good chance that this intermediate line on the market forecast chart pulls back below 50. But again, that might mean we only trade down towards 2650. And again, the worst case scenario down into this area. But you see how bearish this drop is, because we fell into the lower half of the range. The other thing that really stands out is the volume. Volume has really picked up the last couple of days significantly. In fact, if you look at today's volume, the trading range was above average. We haven't had that for a while. Yesterday we had that, and then again, even bigger today, bigger range today, slightly bigger yesterday than average, and then today's move. But if you take a look at the volume, sorry, this is the chart I want to show you. Today was different than yesterday because we had bigger than average. So bigger than average volume, bigger than average trading range. You see that here on this chart. So again, getting above 3%, we'll see if that ends up kind of being a little bit of a fake out move down here. And before we get, I've always said that we get the low point, no matter where it is, up, down, or equal to this one. But we'll get the low point that leads us to our longer term run after we hit the 3% mark. We just happen to go a little bit below it in this case with this little head and shoulders peak that we're getting on the right shoulder. If you take a look now back to the other thing that stands out to me today is if you compare this drop over 2 days to this one that also pretty much occurred over 2 days, because the third day we gapped down and then rallied. So really it was a 2-day drop. Well, most of this decline occurred overnight, right? There was a gap there, but you notice we didn't change much from open to close. We didn't change much here, a little bit from open to close, but not as much as we fell overnight. And then, of course, from open to close here, we rallied. So most of this drop from this close, from that high point, all the way to this low, most of that, if not about half, at least half of it, if not most of it, occurred overnight on very light volume trading. And you can see that can be overcome pretty easily. We filled in all 3 of those gaps within the next couple of weeks. This one's a little different. No gaps here. And what gap we did have this morning, and for that matter, a little bit of a gap there, we filled in. So most of this selling from this high point down to here occurred during a regular trading session, in this case, with above average volume. So that makes this a little different than this one. Not to mention the fact that we crossed into the lower half of the range. So that's why I'm a little hesitant on this, a little bit more bearish on this drop than what we had. Again, does that mean we're going to fall sharply to the downside? No. Again, does that mean that we can fill in? That we can fill in this gap? I still think that that's a common gap that is most likely going to get filled, which means a move about another 10 points to the downside potentially towards 273, that 273.5 area. Then after that, we still have the gap from before. Let me go a little bit further back in time, but we still have the gap from before right over here, the April 6th gap that I feel like was also a relative common gap because it didn't have an increase in volume from what we had seen previously. I still think that that's a pretty decent opportunity. But again, worst case scenario, I still think that that's a very common, very likely gap to fill in, just like I thought in Friday's video that the 2 gaps from last week was very likely to fill in. Going into this weekend's video, we talked about, are the Qs going to drag us up, or is that resistance going to hold on the S&P with all these different indicators, and we'll fill in these gaps? And I said, we'll know by early next week. Well, here we are Wednesday, and we know. We filled in those gaps, and we filled it in with a more bearish move than the last bearish move we had on this head and shoulders, potential head and shoulders pattern that we have forming here. Let's take a look at the volatility, because that's another thing that stands out too, a distinction between this drop and the last drop we had. So the last drop that we had over here, the volatility got up towards 100%, got a little bit above that. This one didn't. In fact, we have fallen back down towards 95% by the end of the day today. So a little bit lower high in volatility and a lower on an absolute basis, also on a relative basis. I said, how are we going to know if there's a good chance the intermediate line not only drops below 80 and gives us a light pink shading in the market forecast, but how do I know if there's a good chance it will fall below 50 and give us the dark pink shading? Well, if you remember, if you get up to 105% on any volatility jump to 105%, then there's a good chance of that happening. Earlier this year, we didn't quite get there, right? I mean, we opened up there, but we didn't quite close above that 105% mark. We didn't quite get a pullback. The intermediate line didn't drop below 50. Over here, in October, we did, and we had a little bit more of a jump right up to this 100% mark, again, coming from really, really low levels, too. We were coming from higher levels over there, but we had come from extreme lows, and we made quite the run in volatility from being in bullish territory, from extremely low bullish territory all the way up to that 100% mark. We didn't quite have that same move. It was mostly in the upper half of the bullish territory, just below the neutral zone, and then it made that jump. And it didn't really get too high, nearly as big of a run in volatility as it had there. And the intermediate line did drop below 50. And you can see another example here where we did get up above 105%. So those are the kind of levels. This pop so far doesn't look like this one, and it looks more like what this might be. Only had really one day that it sharply moves up throughout the day, and even these 2 days, we don't really. Yesterday was our biggest kind of open candle, and when we get these big open candles, they're typically falling by filled-in candles. One more thing to point out on the daily price moves, I've also talked about before. The historical volatility, we were looking for that on the retest for the implied to jump back up above the historical. That hadn't happened yet because we were still grinding higher. Well, now, in this case, the historical actually did fall all the way below, and now the implied is above. And that's a bearish, that's normally pretty bullish when you're on a bullish trend, but we're not on a bullish trend. We're on a, more of a, this is a lower high point, and we're, peaking here and rolling over. So that's something to keep an eye on as well, is that we've bounced back up, and we might be, doing this kind of move where we push higher for a while and bring the historical volatility back up again. And again, last thing is these kind of moves, these bigger moves, about 2% drops, they're typically followed by same size moves. So we'll see if we get a similar size move to the upside tomorrow. And for us not to be bearish, right? These are some pretty bearish down days compared to the last drop. For this to be, kind of rectified with a good bullish move up where the Qs break us out again and we get going, right? Without more of a sustained drawdown and filling in some gaps here, like this gap, if not down further, down towards this gap, right? So what's going to do that? Well, any rally we get tomorrow, Friday, by the end of the week, it does not need to occur overnight, right? We need it to occur. We need a good 1-2% candle here on this histogram chart to occur during the regular trading session with regular volume, not overnight with extremely light volume, with an opening up a gap that can be filled in later. If we don't get that, then look for, if we get a big move to the upside tonight or early in the morning, then look for this weakness to persist. So this can, at least a consolidation, to be more of a sustained, not fall off a cliff weakness, but more of a sustained consolidation here. And that's actually the pattern that I anticipate, right? So if I had to guess on what I expect, and I could be totally wrong, and it wouldn't be the first time, hardly. But considering we've been so bullish overnight lately, and a lot more than during the day, and then this weakness has occurred during the day, I think that we might, this might be the signal that points us to some more consolidation. Again, not fall off the cliff. We're not going to grow to, I don't believe we're going to go to lower lows, but I do believe that we'll trade within the range, the lower end of March's monthly range, and we consolidate more. And the question is going to be, as we consolidate more, what's going to lead to the downside? Is it going to be the Qs or IWM? And right now it's looking like it's going to be IWM and not the Qs, which will mean that we'll eventually, when this consolidation is done, it might be a week or two, it might be a month or two, that the Qs will lead us back out. If it's and we'll get until they're extremely overbought, like we saw in the late 90s, and we'll see what happens there. But if the Qs lead us way to the downside, then we might get more of a bearish drawdown. We might drop towards that worst case scenario or lower, towards 2100. And then we would get the value that some of these people aren't seeing. Buffett and Druckenmiller and Tepper. Right? We might finally see that value show up because these large cap tech names are dropping and giving us that value. I actually don't expect that to happen, but that's what we would have to see. I expect more of small caps leading the way to the downside, Qs holding up, and then leading us up for a year, 18 months, or whatever, until they're so extremely overvalued that and everything's been pulled forward, that then that leads us to the eventual drawdown. And who knows when that's going to happen within the next couple of years. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree, and comment down below as to why. What do you see that puts you in favor of that assessment? What do you see that puts you in a disagreement with that assessment? And share with our community so everybody can see the same things. All right, now let's take a look at what's driving this price action. So let's come over here to the asset class comparison. And then we saw the comparison chart of the Qs to the IWM. So Qs are really holding up well. And you'll actually see that here. So let me go over here to May, and we'll look at including the open here. So there we go. So here's the small upside open we had 2 days ago. So during this 2-day decline, interestingly enough, crude oil, at least measured by USO, which has been so beaten up for other reasons, it's actually not dropping as much. What we have, look at the small cap and real estate really getting hammered during this decline. And then you have an increase, which is not surprising. When you have a big 4% drop in equities, you have an increase in bonds and safe havens, right? Bonds, gold, high yield bonds is doing well. Look at emerging markets outpacing and international markets outpacing the U.S. With the dollar down a smidgen, right? It was down actually earlier. It actually rallied today. But interesting patterns nonetheless in some of these charts. You take a look at that dollar, and that's an important thing to watch for us here. It's kind of skewed, so let me change this really quick. There we go. There's a bad print on the dollar futures on that cash index that we track, DXY. So let's look at UUP as an alternative. You can see that UUP is still showing a kind of a bullish pattern here, bullish, a dark green shading and a green line. You remember we need it to be, and that's on the daily chart. Here's the weekly chart. Stocks are more bullish here, so the more it rallies, the more it's going to be hard for stocks to really take off. And if they do, it will be a large cap tech name rally, because that's what does well in this environment. Rather than say like financials. And the struggle financials are having in industrials, the struggle financials are having is we cannot get going on the yields. Right? It's not dropping sharply. We're not back to dark pink shading, but we're back to a red line. And we don't have the dark green shading in the green line anymore, and that was only 1 day. So we'll see. We'll see if this is just a one short-term pullback. But if we get some more weakness towards 56 basis points or lower, then again, it's hard for risk appetite to take off without some of these other asset classes. Here's crude oil. Crude oil does have a bullish pattern finally. But remember, this is lagging. And if you recall, crude oil actually peaked. It actually got to a higher high in 2008. So it's that lagging. So I wouldn't put a whole lot of stock into crude oil being a leading indicator, since it took a while to get going to the upside after stocks had already started to the upside. So it might be just finally lagging behind. But what's important is, does it break through important levels support or resistance levels. That is an important distinction to keep an eye on, and we're not quite there yet. But if we break through this area on crude, let me get rid of the expiring cone for a second. If we break through this area, look how much volume there is on the futures contract. It's going to be very easy, and this wasn't the mess. This was the Saudi-Russia mess, right? If we were to break back into that gap, then we can make a good run on crude oil back up to $50. And again, that won't happen. That won't happen with stocks, being bearish, right? So, a good sign here, but also an indication that if this holds, this resistance holds, then that's a good sign that we'll have more consolidation in equities before we can make that type of move to the upside. The big news for today was inflation data, right? Yesterday was CPI, today is PPI. These inflation numbers, again, the year-over-year figures are the important ones to keep an eye on, and you can see the year-over-year change in the headline number has fallen to negative levels, and then on the core has been cut in half from last month. So big drive. Remember that the Fed doesn't care nearly about hyperinflation as much as it does deflation, right? Because you can raise rates as high as you want to raise them to offset hyperinflation. But, as we heard today, the Fed does not want to drop rates below zero to combat deflation, because that hasn't worked. It hasn't worked anywhere else to combat deflation. So the Fed is a lot more concerned with deflation than it is in hyperinflation. So, and that's been, the big numbers here last couple of days on a PPI basis as well as on a CPI basis. You can see didn't quite on a headline basis get to negative, but still pretty low on a year-over-year level. And you can see that the core is also dropping pretty sharply there. So, important to keep an eye on these inflation figures, because that's going to drive inflation expectations, and that drives Fed policy, as we've seen. And you can see from a economic surprise standpoint, we're off of these sharp lows, but we're still at very negative levels that we need to kind of get going to the upside to really feel confident about this disconnect between Wall Street and Main Street to start to connect again, because there will always be a disconnect between the two, because the stock market prices in expectations. Not until there's a established trend do both of them go in the same direction, Wall Street and Main Street. And so, for the Main Street to get going in the same direction, for a good trend to get established here, then we need to see these economic indicators continue this sharp run up towards zero and not stall at what would be a resistance on this chart if we were to graph this. One more chart I wanted to show you here on this segment is how the different foreign markets are behaving. Again, you can see dark green shading and a green line. Still in China, still in Japan, still in India, still in Korea. So very Asian dominant outperformance. But if you look at Europe, we got light pink shading and a red line. We got light green shading and a red line over here. And you can see how we're flirting with getting at least a yellow line, but light pink shading in Germany and the UK. Canada, Brazil still looks poor. Russia has a light green shading. Canada is too, getting below the 80th percentile there. So we're starting to see a lot of weakness here across all these major, the world's largest economies in their ETFs that try to replicate their, the biggest stocks in those respective economies. So let's do the same analysis on the sectors, and you can see lots of pink shading, and you have some yellow lines. You have a red line on financials. Industrials doesn't look good. It's close to having its own red line. Real estate's looking like it's about to have light pink shading and a red line. Utilities does have dark pink shading and a red line. These are some pretty bearish patterns. The only things that aren't nearly as bearish yet were your QQQ leadership again. So if they lead, great. But industrials and financials, this is actually more reflective of what the Russell looks like, because those are two pretty big sectors in that index, in the small cap index. And you can see they're not looking so good. So big discrepancy between these three up here and these two. And these two, they don't have to lead all the time, but they should be, as bullish during a regular bullish trend. than what we're seeing in these cyclical areas, and we're not quite seeing that. In these dollar-sensitive areas, materials and energy, in a good bullish market, we want to see them lead too, because the dollar's weak and economic expectations are high. They're economic growth-sensitive areas as well, and they're not. And the weakness, when it's broad to include safe havens as well, then that's more bearish than normal. So these are all some sector performances that raise a little bit of a red flag that suggests that we might not just be down for a couple of days and the Qs are going to get us going. It might be we might consolidate for a few weeks or maybe a month, and then the Qs most likely will get us going, as long as they can maintain that outperformance during this whatever period of volatility or consolidation we have, however long it is. All right, so that brings us to our trade idea of the day. It was actually in the industrial sector. Let's take a look at Honeywell. Honeywell's had a bad couple of days here. It broke down, really broke below its moving average. Was already flirting with it to begin with, but now it's got to change. Instead of doing a bounce and it looked good for a day, and 3 days later, not so much of a bounce. So the intermediate posture is turning bearish. Again, really bearish short-term sentiment. More bearish than we've seen. This case, we're breaking through a lot of different lows here. That's on the daily market forecast. The weekly, you can see, we're really rolling over here and well below, and back to dark pink shading there as well with the momentum line dropping. The week's not over yet, so keep that in mind. Take a look at its 3 green arrow chart, and you think, man, we're so oversold on Honeywell. Well, not really. We have 3 red arrows. The MACD and stochastics look bearish. But remember, the stochastics, that's a reflection of being down at that low, is a reflection of buyers or sellers being in control. You can see the MACD is not very low, and it's got some decent run. That's moving average is just barely below 0. So in the 8 and 17 day are just crossing below the 30 days. So there's some opportunity for this to run. You look at its RSI and CCI, you can see breaking below 40, breaking below 200. So that's the opposite of what we've been looking for on a bullish basis for these major indexes. So those are some pretty bearish breakout moves on those indicators. If you look at this, you can see we broke above 30 and below 20. The negative broke above 30. The positive broke below 20. Remember, the biggest move on the DMI for bearish stocks are right at the beginning, right? So you would think that that's got some more room to run, even just to get up to 40 and below 10. But that's where, that's typically what these bearish moves look like. And that one, we had another day or so, and then it kind of stalled and continued lower later. So I'm actually looking for some more bearishness here based on that pattern, if that plays out. If you look at its Ichimoku cloud, you can see we're back below the cloud here, well below the cloud too, not just flirting with it like yesterday. And then we're at a negative. We're not quite to moderate strength, so we've got some opportunity for that to get even stronger on a trend strength basis. And then finally, its weekly chart, you can see also looking pretty. We got a bearish candle there, and we're just rolling over. It's one thing to get really bearish and then get bullish from there, but here's a really bearish and here's your rollover pattern. This is the type of pattern I expect to see coming here, whether we get to lower lows or not, or just filling in this lows. That's the type of pattern I expect to see here. So we have an opportunity for a bearish directional trade to come out of this. Remember, I already put this trade on. We did this during the Market Outlook Live at 3:30 Eastern Time. But you can see we bought the 110 put for June and sold the 105 put to offset its cost. So this is what the trade looks like here. The 105 was a lot closer to the 20 delta actually when we got into it. But that's what the trade looks like. It's got a good potential reward. It's got a little bit of risk to the upside, $660. That's your potential reward to the downside at 23.40. We've got opportunity for it to run up, bounce back up, even just a little bit. And I've got plenty of room to work with from a risk management standpoint, and a good reward for that risk to the downside, nearly 4 to 1, so about 3.5 to 1 reward to risk plus to the downside. So, and that's in the worst case scenario. That's if we don't get out any earlier with a smaller loss. It's because we reversed this downward move of the last couple of days that quickly. So we'll see what happens. But the technical suggests that there is a good directional opportunity for a stock like this to the downside. And I didn't show you the Bollinger Bands. One more chart on the Bollinger Bands here. Right. Bollinger Bands right here. You can see that we are well below the value area, well below the point of control, well below. And this is not like a tightrope, right? Where if we were this far above, then you'd be worried about how bullish we were. This is opposite, right? This is pretty significantly bearish. That was the one volume node we had down here, and we are pulling away from that volume node, and the path of least resistance is to the downside. So again, kind of shows us the directional opportunity breaking below the lower band, as well as breaking below the lower Keltner channel too. If you look at the Keltner channels, you can see also breaking below that lower channel, and that can be bearish when you're breaking through that lower channel. So again, bearish patterns all across the board. If this is a fake out, we pull right back above 130, then we can take a small loss. If we continue towards 105 and 110, then we have a really good reward for the small risk that we're taking. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there to go to our forums at marketscholars.com. Open up any thread with any questions or comments you have on today's video. You can also reply to anybody else's threads, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow me on Twitter for more content between videos, and join our Facebook group that we've created, as well as our community at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.